Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Hello and welcome. Before we start, I just want to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis, or on any related items on these my charts. This was all my own work, original work, as I think you deserve to have that. So with that, Chicago soybeans. 22 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 958 to 1099. This pattern is still operational, even now, and we are now closing in on the lower trend line. We've already tested and are still testing a longer term pattern, a bright green 2019 today uptrend, currently at 1026, and it explains why prices have hesitated late last week and this week as well. Overall, we are still following the outcome of the mid-July break below the bright red late April to mid-July expanding wedge pattern, made up from the fairly flattish upper trend line on my daily chart, currently at 1084, which linked the highs from the two tops of the May to June base double top, and the lower trend line, currently at 1001 and 3/4, made up from the lows between mid-April to mid-July. The move lower took a while to start, but it is now moving. 4 weeks ago, I commented on the situation thus, and I quote, "So whilst it's a bit early, I still thought it appropriate to set up some potential targets below for the bright red expanding wedge pattern. Thus, a primary target X would be in the 991 zone, tying in with the lows of March and April, whilst a secondary harder to reach target X1 will be down in the 944 zone, tying in with the September 2020 low at 942 and the August last year low at 940, end of quote. 3 weeks ago, prices reached the primary target X down in the 991 zone, as well as the primary target for the earlier mentioned double top at 994. Prices then pulled back for a bit before resuming the move lower and creating a bearish halfway hesitation between early July and now. Last week, the market pushed down to target X2 at 970, the secondary and harder to reach target for the double top pattern. In all this process, it started to become clear that we have quite a steep bear channel developing from late June today, currently 933.5 up to 987 and 3/4, which is now highlighted in dark blue on my daily chart. It will now be interesting to see whether the bearish pressure will push prices down even further and still remain within the dark blue bear channel, or will the old bright green uptrend or the more recent bright pink uptrend, which after all actually is only a 2-pointer, whether they will disrupt the bearish pressure. I also note that in addition to the dead cross pointed out last week with the short medium moving average, currently 1026, heading down through the declining medium moving average, currently 1032.5, we also had this week the short medium moving average pushing down below the declining long moving average, currently at 1025 and 3/4. Please once again note these are lagging indicators, but they are nevertheless still indicators. Chicago soybean meal. 17 weeks ago, linked some of the recent highs into a bright red downtrend, currently at 283.30, that tied in nicely back then for a while with the descending long moving average, which is currently 296.10. The long moving average was then just about shadowing the downtrend, but a little higher up, along with the medium moving average, currently at 290.10, which earlier had failed to provide much resistance above, but then suddenly energized itself as a resistance, and quite good one, over mid-May to mid-June. Despite 11 weeks ago prices closing above this bright red trend line, those closes proved to be a false break higher. And it was only in late June with a clear break below the next drawn trend line, as the purple lower trend line, currently at 281.5, of what together made, initially, a descending triangle and later morphed into a descending wedge pattern. As I mentioned, the break higher was a false break, and in late June we finally had a break lower. However, it took 2 separate goes and a third one this week at retesting back up towards the lower purple trend line. now teamed up with resistance from the August 2020 low at 281.90 to affirm the final move lower and set up the opportunity for the whole early June to date action being a possible bearish halfway hesitation. That seems now to be actually morphing into a late June to date descending expanding wedge pattern with a fairly flat upper trend line, which I haven't drawn as yet, but it's based on the August 2020 low at 281.90. And a lower trend line which I've chosen for now also not to draw, as I'm unsure of its true placement, but it is in the 254.5 zone right now. I shall watch the action, especially any attempts higher, such as this week's 3-day bearish evening doji star pattern attempt. The bearish gravestone for that was written on the second day. Anyway, all this was enough for me 5 weeks ago to set out some targets below for both a descending triangle and a descending wedge pattern. Thus, for the descending triangle pattern, we had a primary target down in the 273.20 zone, with a secondary harder to reach target X down at 255.60. For the descending wedge pattern, we had a primary target down in the 272.30 zone, with a harder to reach secondary target X1 down in the 242.80 zone. As you can see, both primary targets for the descending triangle and the descending wedge pattern have been achieved, just leaving the harder, in some cases much harder to reach secondary targets further down. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. I said I'm afraid I have to repeat something I've now highlighted for 113 weeks, yes, well over 2 years now, and I quote, "I now only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "If there is only one thing you take away from any of my musings, let it have been those words." End of quote. These last few weeks have shown once again that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. 7 weeks ago, we had a gapping move higher that punched up and out of the earlier showrunner here, which is the shallow bullish shift pitchfork with a mid-September to late December 2024 move. Now, 6 weeks ago, we stabilized over the upper time, and 5 weeks ago, prices pushed higher over the 50% Fibonacci line of the March 20 to April 22 move at 53.59. A small gapping move higher since filled in. Now, prices utilized the 50% Fibonacci line at 53.59 as a base for the next move higher. This 50% Fibonacci line is actually quite interesting, as it's the gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action had earlier caused a monthly key reversal up here for June, and this leads me to what may be the most or more dominant pattern now, and one I mentioned 8 weeks ago. It was, as I said at the time, and I quote, "A new pattern emerged over the last month or so, and one that I warned may kick off 2 weeks ago," so that is now 10 weeks ago, and has actually done so since, though the break has not fully stabilized as yet. It is a dark blue start of April to end of May ascending wedge pattern. End of quote. And that's currently 51.31 to 59.82. This pattern has the appropriate number of touches on each side, and back late 10 weeks ago had a brilliant breach and break lower, but as I said 9 weeks ago, and I quote, "Clear consecutive closes below this dark blue lower trend line, I would feel obliged to lay out potentials and even possible targets below for this pattern, something I'm not confident in doing just yet, as I fear a possible false break lower." End of quote. Since then, this pattern has repaired itself and we are back well within it, climbing higher during most of July after June's monthly key reversal up, but turning lower once more in late July, with a weekly key reversal down last week when prices started to enter the overhead congestion, stretching from 56.34 up to 59.44, and found it only too easily eroded the bullish incentive. Now there is one other feature I'd like to just draw your attention to, and it's to look at the possibility that the lows of April and June can come together to form a new lower trend line, currently at 47.94, and it's highlighted in bright green on my daily chart. This would be a new lower trend line to the original ascending expanding wedge pattern. I've still not fully explored this idea as yet, but I feel obliged to lodge it in both your mind and my mind, just in case.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.